Hi everyone, good afternoon or good morning or wherever you are. Welcome to the webinar. This is a collaboration, a webinar collaboration between Delivering Age Communications and C9 Hotelworks. This is actually our silver anniversary today. It's the 25th that we've done during the COVID period, and it's a masterclass. It's the second masterclass that we've been doing, and today we're going to be talking about hotel branded residences, insights into a key driving force in new hospitality developments. So I'm absolutely delighted to have you with us. We have about 500 registered in the audience, and owners, developers, investors, brand managers, and media. And we're going to be talking about a really prolific global trend. And to be honest, that was pre-COVID. Branded residences have performed really, really well during this period, and we're going to look at that. And they've just shown incredible resilience. But we're not just going to be looking at the luxury end, because that's the typical thinking behind branded residences. We're going to be looking at lifestyle. We can look at upscale in Asia, and also we have a special segment on Europe. So thanks everyone for joining. Today our speakers are Jeff Tisdall, who's Senior Vice President Development, Residential and Extended Stay at Accor. Thanks for joining us, Jeff. Anand Rambachan, Head of Branded Residential, Intercontinental Hotel Groups. Chris Graham, Managing Director of Graham Associates. Ladashel Kovnikova, who's a partner with us worldwide. Andrew Corkery, who's Group CEO, Cello Group. Pekka Hirvi, who's Assistant Vice President, Franchise Global, the Ascot Limited. And last but not least, Bill Barnett, the Managing Director of C9 Hotelworks. Right, just quickly before we get going, there's a Q&A function at the bottom. Please put in your questions as we go. We're going to run a series of interviews and a series of presentations, and we'll get 10 or 15 minutes at the end for questions. I will accumulate all of those and we'll ask them to the panelists at the end. Oh, and there's going to be a recording. So there's going to be a recording of the sessions, so there's a recording of the presentations, which is going to be sent to you all after the session, and you can then download it. Right, Jeff, Anand. We're first up, and I'd really like to start with you, Jeff, if I may. If you could unmute, please, and just to let me know, let us know, just kind of set the stage a little bit. Branded residential performance during the downturn. How did it go?
Well, thanks very much, David. It's great to have an opportunity to speak to everyone this afternoon, and of course for Chris and everyone in Europe early in the morning. I guess the way to describe branded residential is this way. It's performed in many respects the way we would expect in a downturn. Obviously, no segment, no sector is immune, particularly to something like we've seen over the last year. But if I were to use one word, it would really be resilient. Once again, in a downturn, residential's proven to be resilient, and particularly branded residential. We're seeing within our own business, we're seeing strong sales continue in a number of projects like Fairmont Residences in Moscow, in Asia, projects like Residences Kuala Lumpur. We've got a number of very, very exciting launches that we're looking forward to in 2021. 15 really headline projects like the OO Residences by Raffles in London. Projects like the Mondrian Residences, which is a lifestyle offering in the Gold Coast, which is going to market soon. And even in terms of signings, what we've seen is potentially a record year in terms of new branded residential projects being added to our portfolio. Now, if you sort of take a step back, and groups like Chris at Graham Associates and obviously Bill at C9 monitor this segment very, very closely, and they'll be familiar with this sort of growth. But if you look at what Savills recently reported in their spotlight in branded residences, we're now at a point where globally there are 500 branded residences worldwide. In terms of openings in 2020, the year-over-year growth was 25%. So it's a segment that's really gone from strength to strength. And quite frankly, we see it as being integral to the recovery, particularly in the lifestyle and in the luxury segments. And because there's so much reliance on mixed-use development, branded residences will really play a key role in helping new developments go forward, get traction, and find their place in the market quickly. So it hasn't been an easy year, but resilience and continued strength are the key themes that we see.
Thanks, Jeff. And what would you like to add to that, please, in terms of IHG resilience? Has that been a key factor for you? And it'd be interesting to see where the resilience has been and why. Maybe there's a brand component in there too. What are your views?
First of all, thanks, David, for having us, and thanks everyone for tuning in. I must echo a number of thoughts that Jeff just mentioned. Look, the resilience again is a key word that comes to my mind. We've had we have a number of operating service residences projects, for instance, which are co-located with hotels, Saigon and Osaka being two great examples under the Intercontinental brand, where we've seen that those have really offered an amazing sort of base cushion to the business that hasn't let the hotel business or the mixed-use business as a whole fall through the floor. That base demand has really allowed the hotel to continue to generate income. They've held occupancy within that business. They've held rate. Equally, I would say that when people are seeking and gone out on vacations for leisure, as we all know, leisure sort of bounced back a little bit quicker than other segments. A number of our guests are actually putting their hand up and looking for residence-like accommodation where they can be a little bit more self-sufficient, a little bit more secluded and private. Equally, again, touching a little bit on Jeff's point, what's really fascinating is when we look at sales, for instance, right? And we have two live projects in the region, one in Hua Hin and one in Halong Bay, which we recently announced, and they've both done phenomenally well. Obviously, there was a bit of a lull in March, April when things sort of went into real lockdown, but since then, sales have come roaring back, and I think that's again a reflection of changing sort of desires and demands in our guests and amongst our customers that potentially want to own a piece of real estate they can call their own. They're where can take their family to for holidays. It's driving distance or a short hop away. Another point Jeff touched on again is on deals. We did see a little bit of a dip in the second quarter, but now that since countries have started to slowly reopen, pretty much every single deal we had going into the year has come back, and we're progressing discussions, and there's many more deals on the list. To your point, David, I think the brand is a key factor here, right? People are looking for confidence in that a certain product, a certain level of amenity service product is going to be delivered to them, and they are ultimately going to be looking at leading brands to be able to make that happen, and they're happy to pay the premium for it.
And thank you. We're going to talk about luxury shortly. Shahan's just joined us, Chief Development Officer at Aman. Shahan, hi, welcome. Just want to before we do that though, just really want to have a look at the lifestyle and the upscale sector. I mean, typically branded residences always been about the luxury sector. So I'm really interested to know your guys' views on lifestyle and upscale. Starting with you, Jeff. I mean, how's the market going? Is this really a dynamic sector for growth? Can we believe in it longer term? Is it going to continue to grow? I mean, it's pretty small beginnings, I understand.
Yeah, it's, I don't know that it's actually that small anymore. It's, if we went back 3 or 4 years ago, we definitely say, it's an emerging trend. I mean, this is a full-blown trend now from our perspective. Obviously, Accor has deep conviction when it comes to lifestyle generally. I'm sure everyone saw our announcement last week with respect to Ennismore and the new independent platform that we're creating for lifestyle brands. What's true of our hotel brands is fundamentally true of the lifestyle branded residential extensions. We're seeing tremendous appetite for those brands. We're already operating today 6 branded residences under our lifestyle brands. We've got another 18, actually now with the signing last week, we got another 19 under development. So those include brands like So, brands like SLS, Delano, Mondrian Residences, and so on. We don't see this as a passing phase. If in some respects, if you look at it, I mean, obviously there are wonderful brands. Enough company obviously has some great offerings in the luxury space. We do, and a number of our competitors do. And we don't see the demand for the classic luxury brands like Raffles or Four Seasons or Ritz or Intercontinental. We don't see that dissipating. But what we do think is that model has really proven itself now over about 15 years. The ability to provide branded residence owners with sort of a best of both worlds scenario where on one hand, they have 24/7 on-demand hotel services available to them and an integration of a hotel asset into their residential environment and the residential experience. But the design that that is now being taken to these residences, where at the same time that they're integrated, they're private and they're separate and distinct. And to Aneth's point, they're really guarding some of the things that are increasingly important in today's environment, like privacy, like safety, like having your own sort of self-contained environment that you can control. Those elements are fundamentally important. But I think what the market's looking for that it hasn't seen until sort of 2-3 years ago is a number of brands that help developers get to new customers. And as deep as the market is for the classic luxury and the ultra luxury brands, there are always going to be some buyers of residences who have a set of needs, a set of psychographic interests that just aren't going to be addressed by some of the classic luxury offerings. And at a core, I think what we're really excited about is just the depth of our offering now with 12 lifestyle brands. It becomes very, very difficult, together with our premium brands and our mid-scale brands and our luxe brands, not to imagine a consumer need that we're not able to address. So we that growth quite frankly accelerating, and we see this as a really enduring trend that will help drive growth out of the current moment that we find ourselves in.
Thanks, Anna. Appreciate that, Jeff. Thank you. Anna, what about COVID outcomes? I mean, do you think products are going to change? Are they going to shift as a result of what we've been through over the last 8-12 months? I mean, is the product changing? You know, are we going to be seeing more demand for standalone, for example, versus co-located?
Look, for the first thing, I think that the demand for, given the kind of sales that we're seeing in the second half of the year across our live marketing projects, post-COVID world looks to be very, very positive for branded residential. I think to Jeff's point, I think that market is going to get, it's deep enough, it's going to get wider in terms of the unique sort of design focused elements and wellness focused elements that buyers are looking for. In terms of co-located versus standalone, look, I still strongly believe that the co-located model probably still makes a ton of sense and should be the focus in resort destinations. It's core to how you deliver the resident experience and the guest experience. In an urban setting, however, I think that game's changing quite rapidly. You can see several luxury brands kind of get quite aggressively targeted on that standalone residence space. Jeff's company Accor has a project right here in Singapore. There's the Ritz-Carlton on Cairnhill Road. I do think that's going to grow. I do think with people starting to have a lot more flexibility around how they live, how much they travel, where they travel to, how they mix work and play, I do strongly think that the urban branded residential model is going to grow, and standalone is going to grow for sure with it.
Okay, that's fantastic. We've already got a number of questions coming in, and there's going to be some more questions for you guys after this session. Our time is pretty much up, and I'm going to hand over. Thanks, Jeff Tisdall and very much indeed, and let's catch up a little bit later. Over to you, Bill.
Hi, David. Thanks so much, and hi, Sean.
Hi.
Welcome to the webinar. Now we've got fast and furious. I've had a lot of coffee. I'm on my 4th coffee, so we're going to go fast. I've got lots of questions. I'm sitting in Phuket, and in 1988. The Aman Puri opened, and that really started this trend about ultra luxury residences. For anybody who knows Aman, again, you know, in our space, when we look for somebody who can get 4 digits on an average room rate, there's less than 5 out there in terms of our broad experience in terms of chains, and Aman certainly is one of those. So I've got a lot of questions, Sean, real quick. We're going to go fast, but you know, let's talk about why do Aman projects, you know, so many projects have resi components. You know, how important is that for you guys to have that equilibrium?
Well, I would say, you know, we do have quite a few projects with resi components, but I think today we've got 33 properties coming on stream, and about 10-12 of them have residential from the start. I think what is important for us is that residential does add a much better potential return on investment for the developer. And certainly when Aman is the developer, and I think we are one of the few operators who also own a lot of our properties, that is very important. You know, so we also get a lot of requests from our guests. And I know you asked me about Aman junkies, but a lot of the Aman junkies want to have a home in an Aman. And so where it makes sense, and particularly in the cities, we do want to have residential. And I think it also allows us to build a permanent community of like-minded people who will keep returning to the property. And, you know, that is the essence of Aman at the end of the day. It's coming home, not visiting a hotel.
I mean, let's talk about almond junkies for a minute. You gotta love that term, certainly. You know, but again, that came out of Phuket. Almond junkies, they're still there, but are they any different? You know, going backwards from last decade to before. What's changed?
Question. I would say the original almond junkies are probably now, you know, the grandparents, right? And we have almond junkies now across the board, you know, from I guess 6 to 86, right? And what has changed is our demographic has gone a lot younger, because where the original junkies who came to Puri, to Aman Puri, Aman Dari, Aman Kila, with you know, their little families and so on, they've had their children have had grandchildren. Everyone still comes every year to Aman Puri, and now they go to Aman Giri, Aman Tokyo, and so on. And so we see the demographic come down towards the late 30s, early 40s, and we do have to evolve to, you know, to continue being relevant, but never losing the essence of Aman, right? The ability to create a sanctuary that's very private.
Okay. I think that, you know, hopping on that question, what about the profile where branded residences today, has the demographic for your buyers come down as well? You know, for your residential buyers?
I would say that it really depends on the location, right? So if you look at Aman Yara and Turks and Caicos, it's still the Americas, still the US, which is the primary market. If you look at Aman Puri, it's global. I mean, everyone, you know, around the world owns a villa in Aman Puri. And if you come to Bangkok, our latest announcement, and the first, well, after New York, the first residences that we've announced in an urban location, the buyers are, I would say, predominantly Asian. So a lot of Thais, Chinese, Singaporeans, Hong Kongers. So it's been a very interesting, you know, it's been interesting to see how the demographic has evolved.
I mean, maybe let's talk about size. Size matters. I'm a big guy as well, but you know, what's too big or what's too small for an almond? You know, in terms of this, you know, in terms of, has that evolved as well? I know early days it had to be small, it had to be intimate, but is that changing? You know, in terms of the size of the properties.
Good question. That's a very good and very difficult question, because as you would know, we've seen 10 key Amans, Amanikas, which is 10 tents in India. We've got a lot of 20, 24 key hotels. And we all know, how do you keep something so small commercially viable? Because it's great to have, you know, an Aman, but we need to keep them sustainable. And we also can't go to the other extreme where we are, you know, 200 rooms. And the dilemma is, you know, we have to keep them as small private sanctuaries, but we can't, and not be too dense, too packed. And I think at the end of the day, it's about striking balance. So what we've seen is, if you look at Aman Tokyo, which is doing extremely well, 84 rooms, perfect, right? So I would say in an urban location, 80 to 90 rooms, maybe max. You know, I would say would stay below 100. That's showing itself to be perfect for the Aman experience in a city. And in a resort location, I still think we will stick to maximum 40 to 50 keys. So still small.
Maybe a quick one. Let's talk about health and wellness real quick, because we've seen, you know, in terms of the new, you know, everything, what's the new luxury? And nobody knows what's going to go on post-COVID and everything else. You say, you know, please call me, because I don't know what's going to happen. What's that mantra changing in terms of your guys' brand, and how are you addressing that?
So I think for us, health and wellness has always been really important. So, you know, we choose locations where your body and your mind can completely relax and rejuvenate and get a new experience. But in recent years, we've added an additional element, right? That's more holistic. So it's now body, mind, and soul. So it's not just having a spa for the feel-good massage, but having places for contemplation, wellness immersions where you cure body, mind, and soul, meditation retreats, etc. So that's very, very crucial to our DNA.
Maybe one last question, because we got a lot of other interesting talks coming on. You got Janu, which is your second brand now. Would there be any intention to have Janu residences, or would you be going into the residential space or branded residences?
Absolutely, and thanks for bringing it up. So Janu is a brand we launched in March this year. We've been working on it for a few years, and the first three properties are in Tokyo, Saudi, and Montenegro. And in Montenegro, we have service apartments that go along with it. And again, you know, Janu is a sister brand. It's going to be quite different from Amman. And yes, we will have residences that go with it.
Okay, Shan, certainly thank you very much. Stay online. We're going to come back with Q&As at the end of the period. We're going to go back to David Johnson in Bangkok. David, over to you. Thanks so much, Shan.
Thanks, Bill. Awesome. Right, well, we're now going to go to somewhere a little bit different from Bangkok. We're going to go to a kind of a chilly London, I think, where we have Chris Graham. Chris is in the UK. How's things over there, Chris? Need to unmute, please.
I'm just waiting for the dawn to break. Actually, it's it's a fairly frosty morning over here, but it's still pitch black outside. Just starting to break.
Excellent. What have you got for us today? I know you're going to focus on the European market.
Well, hopefully you can see my screen, which I've just shared. Splendid. Okay. Right. Well, firstly, thanks very much for inviting me to join the panel today. Before I start, I'd like to give out a very quick word of thanks to my friends at Savills who helped me at the Savills International Development Consultancy, because they ran off the latest figures for me from their very comprehensive database of global branded residences. So the data that I'm about to share with you is actually up to the minute. So I'm conscious that time is quite tight. This is a fairly whirlwind tour that I'm going to give in about 8 minutes, which I'd normally do in about double that time. So let's jump straight into it, and we'll set the scene here with a sort of a global snapshot of what we're looking at in terms of global branded residences. Today we have over 900 residential schemes either operational or underway in over 180 locations across about 64 or so countries. Of these, there are over 500 completed schemes globally, with a total of about 76,000 residences. And the sector's grown by 170% or so over the past decade. And correspondingly, of course, the number of brands participating in the sector has more than doubled. Of these, hotel brands, particularly luxury hotel brands, still dominate. I think it's about 85% of the schemes out there. And just as an interesting perspective on pricing, over the past decade, consistently, and certainly since the research I've done on my reports and many other studies that have been done, it's interesting that the average price premium on branded residences has hovered consistently around about 30%. It really hasn't shifted. Now, there are massive variations depending on destination, but it's always been around the 30% mark. So what's been driving this exponential growth? Well, I'm a marketeer, so I'm going to look at it from the buyer's perspective anyway. But fundamentally, you know, we wouldn't have a market if there wasn't very strong demand for this. And when I was doing my research for started writing my reports, and I started drilling down into what this was all about from the buyer's perspective, which was making them, you know, to snap these things up, and which is underpinning this enormous growth, I distilled it down into two key areas, which were convenience and confidence. And looking at these in a little more detail, and I'm not going to dwell on this now in the interest of time. It's been well covered in my report and many other reports out there, and I'm sure many of the viewers all know this, but there is a very broad range of benefits. It ticks an awful lot of boxes, this concept. And that's why people are you know, the growth in the market is just so significant. So it's not just about the buyers. One of the things that really attracted me and motivated me to start writing these reports is the fact that it's what I call a win-win-win scenario. It's that all of the participants in this concept benefit. There are significant benefits for each one, and you know, for the buyers, I've already touched on those. For the developers, there are you know, very significant financial benefits and velocity and so on. And the brands, of course, and leverage. It's a new income stream and so on. So I'm not going to dwell on this because, again, I'm sure most of the audience already knows this. But it's important to understand that yes, there's a strong demand for it, but everybody in this equation benefits from it. Let's have a look at the global situation now in terms of the completed versus pipeline. Globally, there are 522 completed projects and 379 in the pipeline, and that's a pipeline growth of about 73%. North America has about 40% of all completed schemes, but interestingly, only about 16% of the pipeline. So the growth there is significantly slower. The APAC region is pretty well balanced. It's got 25% completed, 25% pipeline. And the Middle East, North Africa region currently has only about 9% of completed projects, but this is set to increase significantly to over 20% over the next 3 or 4 years. And as an example of that, Egypt is the fastest growing country in the world, rising from 1 completed scheme to 18 schemes over the next 4 years or so. And then finally, and partly the focus of my presentation today, is Europe. And Europe currently has only about 13% of completed global schemes, but it accounts for 17% of the global pipeline. So there's a lot more happening in Europe. Let's take a closer look at this. So if we look at the number of developments by countries, we can see that this is dominated by Turkey. Turkey have really embraced this concept. They have 13 completed schemes with 10 more in the pipeline, and these are large schemes. This is a total of just about 3,000 residences in all. And then in second place, we've got the UK with 11 completed schemes and 10 more in the pipeline. So again, it's going to be a fairly dominant player in the European market. But what is interesting in this is the total number of residences is less than 50% of the residences in Turkey. So it's there's quite a variation there. Then we move into Portugal and Switzerland with 6 apiece and 6 in the pipeline. Switzerland, 6 completed, with only 320 residences and 6 in the pipeline. But what I find really interesting about this is France and Spain. I mean, these are 2 major tourism destination, global tourism destination countries, and yet in France there are only 178 branded residences in total across 3 completed schemes. And in Spain, it's even more extreme. There's only 1 completed scheme in Madrid, the Four Seasons. You know, you look at these figures and you just think, well, you know, why is this? Montenegro came up earlier. I think it's worth looking at Montenegro because there you've got a country of about 650,000 people. And yet within a probably 20-mile radius, you're going to end up with about 6 different luxury branded residences there. So there's quite a lot going on in that small country. And one that's not on here, but I think it just shows the variation that's happening across Europe, is Cyprus. Now, Cyprus is just a short boat trip south of Turkey, and yet Cyprus only signed, and again, it's a major tourist destination, but it only signed its first hotel branded residence scheme in September this year. So, so again, the variations between the countries and the traction that is getting, it varies significantly. Another thing about this is just looking down the list. We know that globally, about 2/3 of branded residences are in urban locations. But when we look at the European situation, it's more finely balanced towards resorts. There's more prevalence of resorts here. It's it kind of reduces to a more equally balanced situation. But yeah, I think that pretty much covers that slide. If we look at the key players now, actually, I just want to touch on one thing. The question I think that comes from this is why is the number of schemes, branded residence schemes, so low in these what are very established and mature real estate markets? And I did some research into this in earlier reports when I looked at the London market. And London's a good example actually, because if you remember about a decade ago, it was setting records in terms of branded residence. At One Hyde Park, £160 million penthouse was sold. Opposite in Knightsbridge, just across the road, the Bulgari a duplex was sold, pre-sold for 90 million. I mean, really chunky figures here. But it was really a combination of very high prices for super prime real estate combined with strong buyer demand. So there was really no need to bring on a third party along with the brand royalty fees that the developer had to pay, and of course the added price premium, which was at that time higher than it is today. And the market, as it's become more challenging in London, we've seen a combination of supply, higher taxes, and of course Brexit. It's made a more challenging environment, and we've seen a corresponding increase in branded residences in line with that. And today, branded residences in London are doubling in number, and yet, as Savills data suggests, the premium now is only around 8%. So why is this? Well, I think it's down to differentiation. It's what the brand can bring in terms of added value to differentiate them from the rest. And just as an aside, there's a section on my report on the Australian market, which I should have a short chapter on that, because it's similar there. Branded residences are now really just starting to gain traction, and I was curious as to why, such a big country really didn't have that many. So just moving on, let's look at the whoops, beg your pardon. The players here. You've got a few of the obvious ones, or the best known ones there. The dominant player has been You, and You is a design-led brand as opposed to hospitality, of course. But they are, with the pipeline, going to be overtaken by Marriott, of course. We've seen Mandarin Oriental and Six Senses leap up the leaderboard as well. Kempinski had quite a presence, but their pipeline is really quite slim, so their growth isn't significant. But I think one of the things that really I find interesting about this data is the number of boutique regional brands that appear on this list. These are mostly lifestyle resort brands. We've got Falkensteiner Hotels, which is a chain of hotels where it started going to residences based in Austria, Italy, and around the Balkans. We've got Martinal. Martinal is based just around around Lisbon area in Portugal. And we've got Fosen. Well, you'll know the brand. That, of course, owns Club Med. That's two Club Med alpine resorts there. And then you've got Lefay, which is again in the Southern Alps. Now, so these are all resort brands, and they're boutique resort brands. But it's interesting to see that they are on the European leaderboard, which I think is quite distinctive to Europe. That we've got the emergence of this type of brand. So just moving on now to the non-luxury.
Chris, we've got about 1 more minute, just to let you know. Sorry to interrupt you.
Actually, we're just moving on to the last couple.
Okay.
In terms of non-luxury brands, the sector's been dominated by luxury brands. We know this over the past few years, and I and other reports have all been predicting growth momentum in the non-luxury, i.e. the upper and upscale particularly, but even filtering down to the mid-scale segments. And You know, my view is that luxury is relative, and it depends on who your audience is. It doesn't have to be five-star luxury. You know, it appeals to different people. And there are some really excellent brands in these lower starred categories. They do what they do very well, and they can offer significant value to buyers in the same way. And I think that these brands present a strong opportunity due to the lower costs for developers and, of course, the lower sales prices for buyers, thereby giving broader market appeal, and notably in emerging markets.
Chris, I think we're nearly out of time.
Okay.
Sorry to hurry you.
Just swifting on to the non-luxury brands, we can see who the players are. Non-luxury brands account for 31% of the total pipeline, compared to 23% of schemes operating today, dominated by main players Marriott with 14, Hilton with 13, Accor 8. And here we can see the kind of breakdown of where that is. And I'll just leave you with a final thought about how quickly this market changes, because when I first wrote my report 5 years ago, I actually quoted HBS commenting on something that's already been mentioned, which is standalone residences. And they wrote that standalone residential products are not a major consideration for the future. And I just thought how quickly things can change in this sector, as most of the major operators who I've interviewed are now embracing this enthusiastically. Anyway, thank you very much indeed for inviting me on the panel. Thanks again to Savills for the data, and thanks for everyone for listening.
Excellent. Thanks, Chris. There's some fascinating stuff in there. And these reports are going to, just remind everyone, these reports are going to be available, so you can download them afterwards. There's a lot of data to get through there. Thanks, Chris. Lada, over to you from a more of a legal perspective. Lada, you with us?
Yes. Thanks very much, David. Hello, everyone. Today we'll be looking at different structuring options, pros, contras, challenges, and risks. So particularly the branded resis as part of a mixed use, as standalone projects that we've mentioned today already, and transformation of unbranded residences into branded at a later stage. Finally, we'll finish with trends in this space in Asia and globally. So our first slide, we'll start with branded resis as part of a mixed use. Now, as mentioned already, this is one of the most beneficial structures for the developer for two reasons. First of all, it allows the operator to have an ongoing business interest in this project in the long term. Second reason is because it ensures that the operator can offer a rental pool, an optional rental pool. Now, having an optional rental pool where the branded resis are located next to a hotel on the same land plot or adjacent land plot means that the developer widens the spectrum of potential buyers for this project, not only to those that are willing to reside in the residence themselves, but also to those who are looking into it as a pure real estate investment generating passive income. By contrast, as opposed to an optional rental pool, with a mandatory rental pool, the effect is exactly the opposite, because the developer will then face a situation where there is a much narrower pool of customers, mainly focused on buying the units as a real estate investment. So to sum up, this particular structure is the most beneficial for the developer and for the individual buyers, and also is a win-win-win situation, as was just mentioned by Chris, for an operator, because it allows to have a hotel and a rental pool structure, predominantly an optional rental pool structure, which allows the buyers to opt in or opt out upon notice. And most importantly as well, that there is, in most cases, shared facility between two components, which then allows to share the cost of maintenance and management between resi and a hotel component. Now, looking at the next structure as branded residences, a standalone project in our next slide. This particular type of project can be very successful for super prime sweet spot locations, CBD and megapolises. But if we are not having that sort of luxury location, we're talking of any other location, this type of project is not, this type of structure is not ideal. First of all, because there's a risk of potential brand damage of an operator in the long term, simply because it is very hard to enforce the implementation of brand standards, having hundreds of individual owners in the building. So in the long term, it may be really challenging to implement and enforce the brand standards in that property, and that property becomes worn out. The second reason why it's not ideal for other types of location is because there is a little appeal to an operator to really manage that asset because of a lack of ongoing financial interest. There is no recurring income. There is no way to generate additional operators fees. So most big groups will not be necessarily too keen to enter into this type of project unless, as I mentioned, it is a sweet spot CBD location. And the third reason why this is not an ideal structure is because, again, in the absence of a hotel component adjacent to a residential structure, the developer will not be simply able to offer any rental pool. And then what happens is that that project will no longer be interesting to those buyers who are looking at this type of projects as pure real estate investment, especially foreign investors. Now, again, to reiterate, this particular type of project can be really successful in sweet spot location CBD in megapolises, and we will touch base on how to address that second concern via structuring, and we'll touch base on that in our last slide on trends. So bear with us. The next structure is transformation of unbranded residences into branded, and we had projects like that. So speaking from practical experience of the challenges involved, transformation means that the developer first develops the unbranded residential, and then with time adds the hotel on the same site or the adjacent land plot, and then is able to, alongside a hotel, to brand the unbranded residences, so it becomes a mixed use, but at a later stage, few years down the line. Now, this structure is not ideal for various reasons. First of all, in the absence of brands, the developer cannot generate any meaningful sale premium. Even if the developer promises the brand at a later stage, this is not good enough to generate any meaningful sale premium. Second challenge is that in the absence of a brand, the developer cannot speed the sell down process. Now, the whole idea of partnering with a brand is to have two main benefits: sales premium and generates a sell down process, because that's when the developer gets all the project financing it needs, not to turn into the bank finance. And that's the two benefits that will not be available to a developer in case they go through this particular type of structure. The third challenge is that the operator may be reluctant to offer a rental pool program to the existing residences because operator didn't collect any royalty fee in the first place. Now, it is a matter of commercial negotiations between the developer and operator to provide some sort of a fee to compensate the operator for bringing the bread into the existing residences later on, and then talk about adding the rental pool structure. And finally, the last most major risk in this particular structure is having a higher risk of Airbnb practices in the existing residences that impact the hotel performance. Now, this particular challenge can be managed if the developer has a foresight about this future transformation of the unbranded residences later on. And if the developer does have that foresight, the project can be structured from day one with all the project documentation necessary to sort of be able to flip into the branded schema very fast and very smoothly with no issues of implementing that schema. If the developer didn't think that through in the very beginning, the problem is to impose any restrictions or conditions, including on Airbnb practices, on the existing unit owners is very, very challenging, to say the least. So my recommendation to the developers on the webinar, please think ahead if you are willing to transform your unbranded residences into branded later on, and then that has to be structured and put in place before you start selling your units off plan. Now let's look at the trends in the branded residences space in Asia and globally. First is the guaranteed returns in rental pool projects. I know there was a Q&A on this particular topic. So to enhance the appeal of the branded residences projects, a lot of developers offer guaranteed returns in their rental pool projects. Now, the challenge here is, unlike the regulated jurisdictions, mature jurisdictions, where the law requires the developer to have a backup plan to back up that guarantee. It can be a line of credit, it can be an escrow arrangement, it can be a bank guarantee, whatever there is. A lot of mature jurisdictions do require to have that backup plan. But in emerging markets, especially in Asia, there is no regulation or very little regulation when it comes to this arrangement. So the challenge here is for the buyers to be confident in a particular developer that that guarantee will be respected. And what happened in COVID year 2020, that a number of developers did fail to default under the guarantee obligations. Whether or not that was justifiable, it's a matter of contract and applicable law, so we're not commenting on that specifically. But what is important to understand is the aftertaste. That particular default does not necessarily only impact the reputation of that particular developer, but it also impacts the reputation of the entire market as an investment destination, especially in the eyes of the foreigners. So the repercussions of those defaults are really long lasting, and developers have to be really cautious when they put the guarantees in place, and they have to think what will be that backup plan, because as I said, the reputation at stake is not just the developers, but also the market in general. And we do recommend the guarantees to be limited in time to make sure you only cover ideally the stabilization period, and the guarantee falls away as soon as the project reaches the stabilized performance. The second trend is the branded residences project, as just mentioned, expanding into an upscale and mid-scale segments. Now, from the unit buyer's perspective, all the benefits of branded residences projects are there regardless of a segment. So it's a hassle-free ownership, it's a rental pool scheme, it's the ability to have a resale premium on secondary markets, etc., etc., etc. So what it does for the developer is it allows to diversify the potential pool of customers and tap into different consumer capacity and pockets. So that's a good thing to have. The third trend is having a white label operator with a brand in franchise. And that works really well for standalone projects that we mentioned just now. So where a branded operator is not necessarily willing to manage the branded residences project as a standalone project, this is a very good way to go and to look at, to have a white label operator approved by a franchisor, and then a brand in franchise from a branded hotel chain. The next trend is having a brand outside of hospitality. So think of Armani, Versace, Moschino, Fendi, Mercedes-Benz, Porsche, Ferrari, etc., etc. All of these are existing projects or under development around the globe. And what it means that this particular project mainly targets the buyers who are willing to buy the units for their own personal living. So these are not for rental pool scheme, because obviously that type of brand cannot deliver the service. It cannot deliver the hotel service and rental pool scheme. And final trend is dual branding. It can be a luxury and upscale, or upscale and mid-scale, one next to each other. It works the same way as any other dual branded hotel. For instance, all the benefits and synergies between the two, tapping into different markets and segments and consumer capacity. That's it from my side. Thank you very much. Over to you, David.
Lada, thank you. Some fascinating stuff in there, and please remember, everyone, that these presentations are going to be available to you to download after the session. I'm going to move swiftly on. We've got Andrew Corkery, the Group CEO of Cello Group. Andrew, you with us?
I'm with you. Thank you, David, and thank you to everybody who's attending today. I'm humbled and honoured to be here. So I'm just going to talk about our journey in the last 11 years and developing a brand, and I'll get straight into that now. Okay, so hopefully everybody can see that.
Yeah, good to go. Thank you.
Great. So our journey started accidentally back in 2019 on a surf trip down to, 2009 down to Lombok. It's now sort of evolved into 200 staff over 5 countries and growing, even though we've amidst this this pandemic. Sorry, I didn't take issues here. So that's the company timeline that you can just see there. That's 11 years condensed up quite quickly. So the question is, why did we build our own brand? The whole journey started, as I said, by accident. And we were never intended out building our own brand. It was an evolutionary thing. Our customers came to us and said, we like what you're doing. Can you help us build bespoke villas, private bespoke villas? We enjoyed going to Bali 30 years ago. We want to be in a remote location. We don't want to have the headache of dealing with local building companies, restrictions, etc. And so they're relying on us to build these villas. And that's what we've done over the last sort of 5 years is build bespoke villas, individually designed to the client's needs, which is obviously a challenge for operators to operate on. But it's certainly been one of the key items of success is that people want to have their own stamp of ownership with what they own. So who is our brand and also who is our client and where have they come from and what are their interests? And it's certainly an active lifestyle person who was in Bali 30 years ago, didn't have much money, disposable income then, has seen Bali evolve into what it is now, likes it for what it is now, but likes it for what it was back 30 years ago. And then that's sort of been what our development in Lombok is about, is aligning those interests with and traits with what Bali was 30 years ago. And building out villas, which now these people have disposable income, they can afford to build and own, and having great vistas and then also the active lifestyle of surfing, hiking, clean beaches, etc. So the good question is, why did we not build our own brand? And as I said, we didn't really know that we were creating our own brand when we began this process. We just listened to what our customer was after and tried to solve their issues, which was obviously building lovely villas in remote locations. And we have spoken to large brands and we have walked down that track with them, and we're still obviously open to do so in other future developments. But where we got to with the existing customer base we had, we don't think that they would align with a big corporate, and that's predominantly the reason that we feel that they wouldn't have been able to bonded with things with the larger brands. So learning how to build a brand, the major lessons learned with this, because we've going from a construction period over to operational period, this has been one of the biggest challenges that we've had. It's a really difficult process to manage. You've got two groups of people, one who wants to construct stuff and one who wants to operate, and they generally don't get on, these two types groups of people, and because they've got different agendas and different outlooks on life. So that's been a real big challenge that we've had in this process of building sort of 50 bespoke villas on this site. And COVID, the silver lining of COVID has been that we've shut down the operation and just focused on the construction. And if there's anything good to say about COVID, then this is one thing. The other lessons learned is finding mentors, and consultants are great. Thank you, Bill. We appreciate all the efforts that you've put into us over the last few years. But having a mentor really helps you, because by mentor I mean someone who's done something that you're trying to achieve in the location that you have achieved. In Indonesia and developing countries throw a completely different twist on things, and it's important that if you do have a mentor, it's someone who has done something in country. And we certainly had one of those persons, and they helped us. They finished building one of their hotels in Indonesia, and we ended up taking his project manager, which was a good learning lesson for us. The other thing that's been of a great help to us is developing core values and selling those core values from your line staff, your construction staff, and through to operating staff to senior management. It's really important that that's done. This shapes the culture of your business, and in turn builds the soft side of your brand, which is really moving from development into operations is the key success item that needs to be focused on. And then finally, the vision. You really have to sell a vision to all people, that whether it's your stakeholder, all stakeholders, be it your customer, your construction, to your operations, and they have to believe it, and then you have to execute on that vision, ensuring that happens. Finally, one of the key successes that we've found, and success I always say is not final, is the vertical integration for us. And it does add overhead and risk, but in situations like COVID, it's enabled us to continue with business, because we've got construction happening and other architectural design and all this sort of stuff going on. So overseeing the entire project from beginning to end is what our business has been about, and taking in that vertical control has given us vertical integration. Has given us that control of the project, so we could deliver on the visions that we talked about in the previous slide. So that's it for me. I hope that's useful to all of you out there. And our journey's certainly been an interesting one, and it's been something which is very rewarding to the group.
Andrew, thank you. That was really fascinating. That's a great and insightful journey. That's not easy out there, developing and building your own brand. Great insights. Thanks very much. I'm gonna hand over quickly to. We've got one more presentation today, and that's Pekka Hervey, who's Assistant VP Franchise Global to Ascot Limited. Pekka, are you with us, please?
Yes, I am. Thank you very much. Thank you
Excellent.
very much. Pleasure. Let me share my screen right away. Get cracking with the presentation. So thank you. I think there was a great presentation already. I'm gonna just speak a little bit from the perspective of a service residences. As Ascot is, we have over 550 service residences around the world in 35 countries and over 140 cities, and we have been excelling the service residence size for over 35 years already. So to share some fundamental points of how the service residence work, and then perhaps if an investor is looking, it's from sales and leaseback model or rental model that Lara was mentioning as well, to have some fundamental things to look at. So service residence, I will be calling them service residence throughout the presentation. They are purpose design built products, and that carries about how we design and how we look at the customer base, the facilities, and so on and so forth, to have that high return on investment. So if a service residence is more dynamically operated, they should be attracting short, mid, and long-term stays. And long-term stay, we're talking about even up to 1 year annual stay, 1 year stay from the corporate and leisure segments. Again, and if operations are more dynamic, it means that there's a strong importance on the sales and distribution, revenue management operations to really drive that ongoing revenue cash flow stream. Whether this is a standalone service resident or if there's a rental pool model or sales and leaseback model so that the individual investors are getting the return. So this is a strong importance, especially when you want to tap on this big wide variety of different customer segments, mid and long-term corporate clients, for example, who's been very, very strong backbone throughout this year in our properties, for example. And lastly, what we have noticed in our properties that we own and lease, as well as then managing and franchising, is that it's really important to really look what are those facilities that one wants to develop, how the unit mix corresponds to the locality of the place, what are we expecting the guest mix to be, the residence mix to be, is it the corporates, is traveler, are they very long-term stay guests? And then how do we design the public facilities, mainly from the restaurant offering, the kitchenettes in the residences, so it really attracts that optimized mix of the guests. It serves its purpose, and then it drives that strong maximized return on invested capital or return on capital employed throughout the life cycle of the asset. Why I wanted to mention, I think Jeff and Anand mentioned about stability, resilience from the service residence or brand residence perspective of this year. I wanted to look a little bit further in the terms of for the past 20 years, which is easily the life of such assets. So if you look past 20 years, there has been a lot of events globally that have been distressing the travel and tourism industry now. We cannot control, of course, this one, and hence we should not be worried about, but I think it's very important that we recognize that there are events that affecting on our industry, but at the same time, there is also seasonality, there's a cyclical nature within that particular location. So this has to be taken also in account when you have a product that is able to attract short, mid, and long-term guests. It obviously mitigates the risk and stabilizes the cash flow performance through the asset life. But I just want to finish the slide in saying on a positive note that throughout these past 20 years, the industry, of course, has been very resilient and always has bounced back, and the global travel has been growing tremendously over the past 20 years. So there's still positive signs. I don't want this slide to be a negative one. So some of the key success factors of a service residence, what we definitely see, I mentioned about stability. I will share also some figures about the resilience throughout this very strange year of 2020. But there's a certain simplicity also in the operations of service residences. It's very heavily focused on yielding on those apartments, making sure the apartments running with the high occupancy, and as mentioned, the public facilities are very optimized. So they are fairly simple, well, certainly more simple operations than maybe a typical hotel product, especially if we are looking at the let's say upscale segment products such as Citadines Apart Hotel. They are typically, due to their lean manning structure, due to the high efficiency and day-to-day operations, they are typically running higher operating margins than again comparable hotel products, which then combined with the cost-effective development cost, will return obviously a very effective return on investments. And the products are very flexible and they're suitable for obviously for being a new build products, but also opportunity for conversions from the office space, office buildings, potentially residential buildings, or well, in our case, we have converted department store in Osaka in Japan to be service residence. So there's truly the flexibility of converting for such a product. They are suitable for dual branding, where we can combine the hotel product as well as the service residence aspect, and then they can be the value value driving hospitality part of a large and mixed use development. Many of our properties are, and I'm sure with all my fellow panelists as well, as a part of shopping mall development, for example, the commercial spaces, office complex developments or residential developments as a part of bringing that hospitality aspect into those developments. So I mentioned about resilience, and Jeff and Anand mentioned as well throughout this year. So it's not really to toot Ascot's own horn. This is throughout the consultancy, and markets has been the same, that the service residence model has outperformed this year in terms of performance. We have seen the similar situation pre-COVID. We expect that to continue post-COVID as well, but truly in this year has provided a very nice stable cash flow throughout this very difficult year for everyone. So what to look from the brand or for the company if you are an investor, if you're a developer, if you're institutional investor, private investor, definitely somebody that has the operational expertise of whether it's a service residence or brand residence goes without saying. And are these the core product of the company's portfolio? Such an expertise of built up over the years, of course, translates to understanding the business model, having the business knowledge, as well as then to help to advise what the unit mix, what the product should be in each location by looking the micro analysis for the location and so on and so forth, and to really help to build that very optimized product, having a higher chance to bring that return on investment. The design expertise, of course, has to be there, and also the flexibility of tailoring those products into each location, which is a very important in today's global world. And lastly, if they're dynamically operated products, then of course you want to have a company which can provide global regional supports in order to tap those international markets, in order to be able to tap into a global corporate accounts, driving the long midterm stay, and really bring a comprehensive demand to these assets to provide that stable cash flow and performance throughout the life, the asset life. And this is my last slide. So I will just share. So I get a lot of this question, and I'm sure this is also the question that is been more and more asked in European markets, Middle East, Africa, and here in Asia. Is this service residence suitable for franchising? And I mean, in short, yes, it is. Very, very suitable for franchising. It's very, as mentioned many times, resilience coming up all the time, but I suppose it's because of this year has been so strained. But it's a stable product. It has a simplicity in operation where we're looking that more of an upscale mid-market positioning, for example, on the higher end products. That simplicity is, of course, a bit less. There are more complex products, but there's a certain simplicity that having operation, which also is franchising. When you partner with the company, with the hotel company, service residence company, such as Ascot, for example, you want to make sure that there is the operational support in terms of a training, pre-opening, post-opening support, as well as those distribution channels to help to bring the international clientele to the assets. Again, whether you are a private investor for a sales leaseback model, or whether you are a more institutional investor, and so on and so forth. And going back to, again, this concept is suitable for greenfield and brownfield project when it's been really designed well, when it's been really thoroughly thought what is the market demand around, and so we can ensure that it actually addresses the market needs. So that is my last point. I don't know if I exceeded my 8 minutes of fame for this one. So thank you very much, and I'm happy to answer any questions online, offline.
Yeah, Pekka, thank you. I think you were just about 30 seconds over, but but thanks a lot for keeping to time, guys. Because we are getting pretty much out of time, but we just got time for a few quick ones. And I'm going to start with you, Sian, if I may. Sian, you with us?
Yep.
Excellent. Hey, I'm just dying to know about Aman. You know, I mean, what is the Aman mojo? I mean, it's a brand that's traveled for 3 decades. Can you share the secret with us, please?
I like to think of us not so much as a hotel brand, but we're a lifestyle, right? And it is very, I think we're very niche, obviously, compared to a lot of my colleagues here who are with, you know, wonderful, really large groups. I mean, we have 33 hotels. We've got, you know, maybe another 10 more in the pipeline. Yes, we have a sister company, but it's very niche. We're growing very organically. It's all about maintaining brand integrity, but increasing commercial viability at the same time. For a very small group of people, we don't need to reach out to, you know, the top 20% of the population. We need to reach out to the top 1%, or in the case of a place like China, the top 0.1%.
That's right. Thank you. Jeff, over to you. Another brand-related question. There's a lot of questions about brand that we've received today. What is the sales premium that you put on a branded residence versus a non-branded residence?
Yeah, the $100 million question, so to speak.
Yeah, exactly.
You know, the good news on brand premium, and maybe just to circle back to the concept, it's really this notion that by licensing an internationally recognized brand like a Raffles, like a Fairmont, like an SLS or a Mondrian Residences or a Pullman Residences, that brand will help the developer achieve a pricing premium compared to an independently branded project, so a brand that they develop themselves. When compared to a similarly located, similarly spec'd project. And it's, you know, so in our business, generally when we're advising our development partners, we suggest to them that, you know, look, the brand adds value, it helps drive sales absorption, it helps lower marketing costs, and a brand premium in the space of 15 to 20% is typically reasonable. Now, there's a lot of variables there, and a lot of things need to go right in terms of planning, interior design, location, execution, and so on. But if you take a step back at that and you look at some of the analysis that groups like Savills and Knight Frank have done over the years, it's a pretty well documented space. And while we see variations between mature markets and emerging markets, while we see variations in resort versus urban settings, those brand premiums have stayed remarkably stable over the years. So in Savills' last report, which is the brand spotlight report from about a month ago that was released, the Savills group led by Ryan found the average premium stayed in the plus 30% range, 31%. So, you know, generally, I think from an underwriting perspective, from a modeling perspective, it makes sense to go with more conservative assumptions. The flip side is, you know, we've seen and we continue to see many projects that not only are absorbed quickly, but achieve absolutely blowout pricing, particularly when we're bringing a new brand or even the branded residence concept like we're doing on the Gold Coast of Australia, launching in the next couple of weeks. You know, this is not only a concept that, as Chris touched on, is really new for Australia, it's lifestyle entering the market at really a critical point. So, you know, we're very, very optimistic generally, but it's a space that I think for developers, probably the best source is to point you back to groups like Chris at Graham Associates, to groups like Bill at C9, and of course, groups like Savills, who have done a lot of research into this.
Jeff, thanks very much. Anand, over to you. He's got a question here from Nigel Cornick from Zen Capital. How do hotel operators balance a lack of hotel revenue on a straightforward residence without hotel revenue streams? So basically, when the hotel's not doing very well and it's not creating the revenue streams, how do they balance that? How do hotel operators balance that?
So this is in context of a standalone project, I assume, where you don't have a ongoing sort of nightly or whatever sales, right? You're on your base fee and incentive fee. Well, I guess the first answer to that question is you wouldn't be doing a standalone project if you weren't in it to make to drive brand premium and to be making a license fee, right? So you're really kind of doing it primarily to be able to support that development and to take to earn income through the license fee. In terms of the ongoing support, that's really more of it's right in pointing out that that's not really a substantial profit center in any way. That's more just the continued involvement. There's more just to make sure that the guest experience and the resident experience is delivered on brand, and that brand standards are complied to. At the end of the day, we got to do what we have to do to protect our brand, so that we can keep driving business into our hotels and into other residences.
Yeah, and quickly, just very quickly for you, Anand, too. How can brand operators deal with the risk of termination, say, when of their management by the juristic in a freehold condo project in Thailand? I know you've got condo projects in Thailand, or branded residence projects in Thailand. And how does that play out? Just quick answer, if you don't mind, please.
Yeah, not focusing on Thailand too much, but generically, it is one of the trickiest parts of how you deal with this, right? And I think ultimately, the inherent protection to some extent that you have is that the people who have bought this, they bought it because they believe in the brand. They bought it, they paid a premium for it because they like that brand experience. It's sort of not in their interest ultimately to kick out a brand and to some extent eat into or erode the value of what they've put money into, right? That's sort of that's really the bulk of it.
Okay, thank you. Bill Barnett, I mean, you've been mighty quiet, unusually quiet today. Some words from you, please.
I think we're about ready to wrap up. I mean, thank you, all you guys. Chris got up early in London. We've got, from luxury, talking about mid-scale, talking about a lot of different products. What we know is we're at the beginning of a new cycle. And, the blend of real estate together with hospitality is different from jurisdiction. There's no, often I'm asked, what's the standard? Or, the answer is from jurisdiction to jurisdiction, from product, it's an evolving space. What we know is, post-COVID coming out of this, guys are going to be doing branded residential. Take luxury as an example, probably 30% of the luxury pipeline has mixed-use projects in it. So as we go in and we see new developers going and doing projects, certainly post-COVID, they're going to want to mitigate their risk and bring these type of products on. And what's amazing to me is there's space at the ultra-luxury space, when you see the Almonds, which sold out massively in Bangkok in the middle of the pandemic. But also we're seeing, in terms of the Accor products and the IHG products, also in the upscale as well, in lifestyle segments, we're seeing development there. And that to me is exciting because it's becoming its own real estate class. So, thanks to all the guys today who are talking about this. I know we're short of questions as well. There's not enough time here, but I think the takeaways are good, and great panelists, David. But it's an exciting space. I think coming through this, it's the beginning of a new cycle, and that's going to be really dynamic for branded residents. We're going to be hearing a lot more about this space in the year ahead.
Thank you, Bill. Sean, Jeff, Anand, Chris, Lada, Andrew, Pekka, and of course yourself, Bill. Thanks very much, everyone, for joining us today.
Okay, thanks everyone.
All the best.
Thank you.